be the fourth industrial revolution, an all-consuming industrial revolution right across the board, the speed of change 1,000 times faster than during the first industrial revolution, and affecting all services, all products, all countries, all industries, and all people. It's going to lead to job destruction, so we've got to think about the jobs of the future and how we create them. It's going to lead to massive technological change in the way we deliver services. It's going to force governments to change their minds about how they operate. And all this has been set out by Klaus Schwab in the speech he made in Abu Dhabi.
And you see, the difference of this fourth industrial revolution is it doesn't change what you are doing. It changes you if you take a genetic editing.
Treasury Secretary Janet Yellen now chairing a meeting of the Financial Stability Oversight Committee where they're going to vote on two proposals on new financial regulations. The first proposal that they're going to vote on is a framework for identifying financial risk. And this framework is going to provide an outline for basically how FSOC works to identify, assess, and then also to mitigate risk. It addresses a criticism that's been out there that FSOC's kind of a black hole that doesn't explain how it does business. FSOC could focus on certain activities, markets, individual entities, the secretary will say. Now, another proposal, maybe potentially more far-reaching, it was also vote on a proposal to make it easier to designate non-bank financial institutions for financial supervision. The current guidance creates, Yellen will say, inappropriate hurdles for designation. Essentially what they're doing is rolling back some Trump administration guidance that was passed in 2019. Under the current rules, Yellen says it could take 6 years to designate a financial entity for supervision, not fast enough given when financial risk is taking place. Now, Yellen does not say what companies could be designated. In her speech, she says designation is an important preventative tool to address systemic risks that may arise from a non-bank financial firm whose activities or distress could threaten the financial system. Pretty wide open. This could include hedge funds, insurance companies, 4 of whom were previously designated, but that designation was taken away. It could be crypto entities. It could be money markets. It could be subject to designation. Firms will have an ability, Yellen says, to engage with the FSOC before, during, and after designation, I guess, to oppose it or otherwise address the reasons they were put into designation. Proposal, guys, goes out for a 60-day comment period before it's active. Back to you.
And thanks to the FSOC staff for the effort and expertise behind the revised analytical framework and non-bank designation process guidance. I'm delighted to support the revised process guidance and analytical risk framework, and I'll vote to approve these documents for release for public comment. It has been over a decade since the Dodd-Frank Act gave the FSOC the power to designate non-bank firms. In that time, the FSOC has gained a great deal of insight into Section 113 designations. We've seen that the financial system continues its constant evolution, underscoring that no single solution can address every financial stability risk. And I believe it is fitting for the Council to regularly assess its toolkit and consider how best to use our full range of tools to respond to systemic risks, whether the risk arises from an activity, an event, or a firm. I'm pleased that the Council chose to publish the analytical risk framework for the first time. The framework provides an overview of how the Council identifies and assesses risks and delineates the range of authorities available to the Council under the Dodd-Frank Act. It also emphasizes that the actions the Council may take will depend on the nature of the risk that it intends to address. The non-bank designation process guidance describes the Council's method of determining whether to designate a non-bank firm. The process allows for several stages of analysis rooted in the analytical risk framework before a designation is approved. Overall, I believe that the changes proposed by the Council will create a balanced approach to addressing potential risks to the U.S. financial stability and ensure that all the tools available to the FSOC will remain on an equal footing.
Thank you, Secretary Yellen. I want to thank the Council, the staff, and for you developing today's guidance on non-bank determinations, which I'm pleased to support. History is replete with times when tremors in one's corner of the financial system or at one financial institution spill out into the broader economy, and such risk can originate not only from the banking sector, as we've seen in the last 6 weeks for sure, but also the risk can originate outside of the banking sector. And early in my public service career, 25 years ago, in fact, when I was serving in the U.S. Department of Treasury, I witnessed one of these events rather up close. I was asked by then Secretary Rubin to fly up to Connecticut on a fateful weekend to visit the highly levered hedge fund, Long-Term Capital Management, which was about to fail. Subsequently, I was asked to staff the President's Working Group review of the matter, and we found that event, quote, highlighted the risk of excessive leverage, the possibility that problems at one financial institution could potentially pose risks to the financial system as a whole, end quote. Highly negotiated sentence, by the way, between the Treasury and the Federal Reserve at the time. The 2008 financial crisis, much greater in magnitude, was yet again an example of systemic risk emanating out from both the banking sector and the non-bank sectors alike, lest we forget millions of people lost their job and small businesses shuttered across this great nation. In response, Congress set up this interagency council, tasked with important authorities and mandates to better guard against systemic risk, recognizing that risk from both banks and non-bank financial companies can emanate throughout our economy. Hurt everyday Americans, Congress tasked this council to designate which non-bank financial entities were systemically important financial institutions, and then such designation would subject them to the regulation and supervision of the Federal Reserve. I was honored nearly 13 years ago to serve on the first council, including when we considered and later approved a 2012 initial rule implementing those procedures. Marty, I think you might have been there as well. As I said when we approved that rule, effective regulation of systemically important non-bank financial entities is essential to preventing risk from such entities from spreading to the U.S. economy. This rule helps protect taxpayers from picking up the bill for such a financial entity's failure. I'm pleased to support today's recommendation, which would reinvigorate this council's designation process in line with what I think was Congress's vision for our work. As important as today's step is, and as the Secretary and Chair Powell both said, I believe this is just one tool in the toolkit. Each of our agencies have important roles within our respective authorities to enhance the resiliency of the financial system. At the SEC, we're working along with fellow council members to do just that, enhancing the resiliency of the U.S. Treasury markets, money market funds, open-end funds, private funds, clearinghouses, dealers, and with regard to cybersecurity, we've also adopted rules to shorten the settlement cycles in securities by half. Lest we forget the risk posed by the near collapse of long-term capital management in 1998, we also must build upon the work of the hedge fund working group. That means looking at large, interconnected, highly levered hedge funds, the associated repo markets for financing, the prevalence of low to zero haircuts in such funding, and the extension of leverage from banks and prime brokers. Those events 25 years ago also impressed this upon me. Though we're never going to get rid of risk in the system, we must best identify, manage, and guard against such risks to protect the American public. I thank you, and I support today's guidance.
Thank you.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, we know the NWO caused the problem, wait for the reaction, and run in with the solution. And we know the Fed created the banking crisis. And now they get to come in and regulate themselves for the next crisis that they're about to cause. Yes, it sounds unbelievable. But remember, they're fighting the inflation that they cause right now. So when you have the Fed controlling the supply and demand of your money supply, I care not who creates the laws. And during the time that we're in right now, guys, we see that everybody's on payroll. Your mainstream media is paid and bought for. Your politicians are paid and bought for. And we're in a time that we need them the most. We need them to start speaking the truth. But unfortunately, it's not going to come from those sources. And when I wrote my NWO book, and then also starting this channel, I knew I had knowledge that others did not have. It was my job to get the truth out. And the same thing goes for you. If you listen to this, it's your job to get the truth out. Because unfortunately, The masses are asleep. They're under a spell. And if they don't wake up, guys, we know by the time they wake up, the robots, algorithms, and drones would have already taken over the economy. And when we go back and we understand history, when we understand when the Federal Reserve first started, those who understood what they were doing were able to take advantage of the system. And the same thing goes with all this technology coming. It is your job to understand it and know that technology can be used for good or evil. So when you do have the devil's tricks come in, you know how to step aside, because the NWO is about to set up one of its biggest magic tricks to distract the masses, so therefore they can run the money in the back door to build the fourth industrial revolution, where the robots, algorithms, and drones take the economy over, pay each other with crypto, and the sheep go inside the metaverse. And remember, the crypto teacher told you, because he knows when it comes to the New World Order, it's all planned out. You have a wonderful day.
We have two items on the agenda today. First, we'll hear a presentation from Treasury staff on the Council's proposed Financial Stability Risk Monitoring Framework and its proposed interpretive guidance on non-bank financial company designations, before voting on both the framework and the guidance. Then we'll vote on the minutes of our February meeting, as well as two meetings that we held in March. Our first agenda item is a discussion and votes on two proposals. The first is the Council's proposed framework for financial stability risk identification, assessment, and response. The second is the proposed interpretive guidance on non-bank financial company designations. Before we turn to the presentation, let me first speak about how the recent banking developments demonstrate the importance of the actions we're about to take. Last month, the government took necessary actions to decisively manage the fallout from the failure of two regional banking institutions. Our goal was to mitigate the serious risk of contagion and protect the broader banking system and economy. The situation has stabilized in the past few weeks, and our banking system remains sound with strong capital and liquidity positions. Of course, we continue to be vigilant and monitor conditions closely. Still, these developments have reminded many of the fear and uncertainty that can accompany financial disruptions. For all in this room, I'm certain that the developments underscored the importance of our work on financial stability, to continue to improve the resilience of the financial system that can support the economy through both good times and bad. Last month's events show us that our work is not yet done. The authority for emergency interventions is critical, but equally as important is a supervisory and regulatory regime that can help prevent financial disruptions from starting and spreading in the first place. I believe that the votes we will take today advance that very mission. We will first vote to issue for public comment a proposed analytic framework on financial stability. This framework provides new public transparency into how the Council does its work, how it identifies, assesses, and mitigates risks to financial stability. It's the first time the Council has published such a document. This framework outlines common vulnerabilities and transmission channels through which shocks can propagate through the financial system, and it lays out how the Council considers the tools it will use to address these risks. The framework emphasizes the importance of taking a comprehensive and rigorous approach. Addressing the diverse range of financial vulnerabilities that exist today and that may arise tomorrow requires a broad set of flexible tools. Importantly, the Council does not broadly prioritize one type of tool over another. Rather, we plainly examine a risk and design our response to address the risk we're seeking to mitigate. Often, the Council will determine that a risk should be addressed by existing regulators, using what is sometimes called an activities-based approach. These may be instances where systemic risks emanate from widely conducted activities in a particular sector or market. FSOC has made activities-based recommendations in traditional areas like money market and open-end funds, as well as in newer areas like crypto assets. Many of these risks and recommendations are described every year in the Council's annual reports, but there may be certain instances when systemic risks could emanate from a particular entity, one that might not be within the jurisdiction of a regulator with adequate prudential or supervisory authorities. In that case, an entity-focused approach may be more appropriate. That's exactly why Congress gave the Council the authority to designate non-bank financial companies for Federal Reserve Board supervision and enhanced prudential standards. And it's why the Council is also voting today to issue proposed guidance that would enable us to use that tool effectively should it be needed. We're proposing revisions to certain elements of the Council's existing guidance that have made it difficult to use its non-bank designation authority. The existing guidance issued in 2019 created inappropriate hurdles as part of the designation process. These additional steps are not legally required by the Dodd-Frank Act, nor are they useful or feasible. Some are based on a flawed view of how financial crises begin and the costs that they impose. It's been estimated that a designation process with these steps could take 6 years to complete, and that is an unrealistic timeline that could prevent the Council from acting to address an emerging risk to financial stability before it's too late. The designation tool serves as an important part of our post-global financial crisis defense. It's an important preventative tool to address systemic risks that may arise from a non-bank financial firm whose activities or distress could threaten the financial system. We're acting today to restore the effectiveness of this authority. As we do, we're also taking significant steps to ensure that the Council's non-bank designation process is rigorous and transparent. The proposed guidance provides for strong procedural protections. This includes significant engagement and communication with companies under review, minimizing administrative burdens on these companies, while providing ample opportunities to be heard. The Council will also engage with the company's primary regulator during any designation review. And through the separate proposed analytic framework, we're providing the public with more information about how non-bank designation fits into the Council's broader approach to financial stability, risk monitoring, and mitigation. In all, I believe that our votes today are a major step towards strengthening our safeguards for the U.S. financial system. We look forward to public comments on these proposals.
Going to a different economy, and we're going to be learning more about that as we go. But clearly, we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
Cryptoteacher and the New World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Seaver, the biotech stocks. And while everybody's at home wishing they were still getting that free money, what are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, you know I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. You know I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Drama Team save the village. Part 2. King Joshua and Drama Team save New York from COVID Stories 3. Part 3. King Joshua and Drama Team goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.